Today, China is re-engineering its economic engine. For decades, growth was driven by debt and real estate, but today the state is reallocating capital towards advanced manufacturing and artificial intelligence. State policymakers have established a growth target of 4.5% for 2026. This stability reflects a transition from the rapid, broad expansion of the past toward a more deliberate phase of industrial upgrading. This structural pivot is changing the investment landscape. As growth drivers decouple, market activity is shifting away from broad benchmarks toward targeted onshore sectors. The property sector remains in a protracted slump. After 5 years of decline, an estimated $18 trillion in household wealth has been destroyed, creating a balance sheet recession where families prioritize debt repayment over consumption. However, the mathematical drag of this collapse is beginning to narrow. New housing starts are already 75% below their peak, diminishing their drag on GDP. Simultaneously, the state-backed new trio, EVs, batteries, and solar, is surging, projected to account for 20% of GDP this year. The data suggests that the gains in these high-productivity industries are now reaching a scale where they offset the ongoing contraction in real estate. Global institutional forecasts for 2026 GDP range between 4.4 and 4.8%. This baseline is supported by robust export volumes as China expands its market share in high-value-added technology. The domestic economy is also insulated by high levels of energy self-sufficiency. China produces 80% of its primary energy internally, providing a buffer against price shocks in global oil and gas markets. To improve industrial health, the central government has introduced anti-involution policies. These measures are designed to curb destructive price wars and reduce unsustainable competition in sectors with excess capacity. We are now seeing the result. The producer price index is turning positive after nearly 4 years of deflation. This shift is putting a floor under corporate profit margins. With energy independence and enforced margin expansion, the environment for industrial earnings growth is becoming more predictable. Despite these shifts, global equity funds remain 6.5% underweight on China. This cautious positioning has left many valuations at historical, compressed levels. Investment outcomes depend on index composition. The offshore MSCI China Index weights consumer software, facing growth moderation. Conversely, the onshore CSI 300 concentrates in hardware, providing direct exposure to sectors Beijing actively funds: AI hardware, power equipment, and advanced materials. Support is also coming from domestic capital. As bank deposit rates fall toward 1.6%, local households are reallocating savings into the equity market in search of higher returns. For allocators, capturing the upside of this transition requires moving beyond broad benchmarks to target these specific onshore manufacturing and hardware sectors. China's 2026 economy is defined by a selective structural upgrade. Productivity and growth are concentrating in innovation-driven sectors, while traditional segments continue to contract. This environment creates a compelling case for overweighting onshore A-shares, which are positioned to benefit from margin recovery and state-led investment. As global capital flows begin to normalize, early positioning in these sectors remains the most effective way to capture the next chapter of China's growth.